And what made it inelastic? It is the reason that, look, people who are sick will buy money at whatever rate if they can't get an official rate. And CBS supplying the market to satisfy those inelastic demand needs will automatically take away a lot of demand from the parallel market. And if those demands are taken away from the parallel market, you're going to see parallel market move towards a convergence with the official rate. So when that convergence occurs or the margin is not significant, there won't be motivation available to round trip to buy from the official market to go and resell in the parallel market.
So you've mentioned that it improves domestic needs, but does this also improve Nigeria's standing for international institutions, investment institutions like JP Morgan and Morgan Stanley? Remember, JP Morgan removed Nigeria from its GBI-EM in September in 2015, not last year, 2015, and that kind of had a negative effect on how investors viewed Nigeria as a whole. So apart from satisfying the domestic side, do you think that this also takes care of how international investors, international institutions like JP Morgan and Morgan Stanley and Barclays looks at Nigeria?
Yes, we try. You see, what we are seeing, I was in one of the parts where the acting director of Central Bank, director of communication of Central Bank, said that this is still work in progress, and that they are still fine-tuning and improving on it. Ultimately, you're going to see an improved level of liquidity. That improved level of interbank foreign policy liquidity will restore confidence of the likes of JP Morgan and Barclays. The reasons why those two indices ejected Nigeria from their index was because of lack of foreign currency liquidity in the economy. And they felt that for them to have Nigerian local currency instruments in their basket of portfolio, that there must be liquidity. People should be able to sell their instruments and convert back to dollar. But when restrictions were imposed on the market, that liquidity was lost. So what we're seeing now is that as more liquidity comes into the interbank market, you're going to see a situation whereby the likes of JP Morgan will bring Nigeria back into a government bond index emerging market, and Barclays will bring Nigeria back into emerging market government bond index. So we expect that not only those two, we also expect that foreign portfolio investors will now see the need to come back to the Nigerian market. A lot of Nigerian assets are undervalued, both and the yield on our fixed income securities are also quite attractive. We're seeing yields of 18% or other things like that. They have not been bullish in buying our local currency debt instrument because of one, volatility in exchange rate, and two, a lack of liquidity in foreign exchange markets. If we restore liquidity, we're going to eliminate the volatility. And those factors, once they correct, you're going to see foreign portfolio investment will come in. And recall that the time we were saying we had 62 billion in foreign reserve, a reasonable portion of that was from foreign portfolio investors. So when foreign portfolio investors come, they will further strengthen the recipient's capacity to intervene in the market. But they will also further strengthen the level of liquidity in the market. And the measures we've taken now are the measures some of us have been asking for. And I'm clear that if central bank can sustain it, then we should begin to see improvement in liquidity, stability in exchange rate, and we should begin to see multiple flows from foreign portfolio investors and home remittances sources.
It's good that you mentioned the sustaining, because JP Morgan gave that as a clause that if Nigeria was able to sustain for a minimum of 12 months, having transparent and a fully two-way functional currencies market, it might begin to consider putting Nigeria back on that index. But oil reserves we have our forex reserves at about over $29 billion, and it's largely dependent on how our oil prices trade on the global market. So what if, for instance, we do not have oil prices at the level that they are, and we can't get enough coming into government coffers? That begins to put a strain on the central bank, and so the Central Bank of Nigeria also will now be strained to look for dollars to still try to supply to the market and ensure that there's enough liquidity for every consumer or every end user, as the case may be.
Well, I think the problem we have now is not necessarily the oil price. The oil price at $55, $57 is quite reasonably high enough. The challenge we have to face, which I'm pleased with what the acting president is doing, is to address the level of militancy in the Niger Delta, to bring some level of respite in the Niger Delta so as to improve production. If we are producing like 2 million barrels per day, and the oil price still continues to trade about $55 to $57 per barrel, Nigeria will just be earning enough foreign currencies to give the central bank enough tools to intervene in the market. But beyond that, what the central bank can do in terms of generating foreign currency is limited. What they've done, they've maintained high yield of fixed income instruments, which unfortunately was not able to attract the volume of foreign portfolio investment they were expecting because of volatility in exchange rate and lack of liquidity. So the central bank has also been involved in swaps, doing currency swaps to further boost its capacity to intervene in the market. But beyond that, a lot of what we need to do to improve supply will come from the fiscal side, such as, one, we measure the issue of addressing the crisis in the Niger Delta to improve crude production. You have to look at the issue of borrowing. Foreign currency loans are not the duties of the central bank to assess in terms of the fiscal authorities. We just got a billion dollars from the international bond market. The central bank, the federal government, also negotiated about 2.3 billion from World Bank and from China. We also need to look at the issue of construction of infrastructure. We need to develop a pipeline for attracting foreign direct investment, including foreign capital into the country. We need to look at what sectors can we easily bring foreign capital into the country, such as construction of critical infrastructure like the rail lines, the seaports, the airports. If we come up with a concept, legal and regulatory framework, and legal and commercial framework that will attract private capital into this sector, we're going to see a lot of capital, foreign capital flowing into the country for a long time. Then we also look at the issue of sale of assets. There are a lot of money assets that are not functioning today, which we are priding ourselves that these are our patrimony, but they are of no use to us. It is the duty of the fiscal authority to handle those things. So a lot of the things that the fiscal authority need to do to help improve supply are outside the control of the monetary authority. And that's why some of us have been saying we need to harmonize the fiscal policies and monetary policies. We need to make sure the two of them are working in tandem to improve the level of supply of efforts, to stabilize the economy, to restore growth in the economy. One of them, the monetary authorities have limited tools and they can't do all those things. So the vacuum we've seen in the fiscal space should be closed quickly, and I hope the vice president who is acting for the president will quickly do that. We are seeing a trend towards his ability to begin to restore that level of confidence on the fiscal side.
Johnson Chukwu, Chief Executive Officer of Carry Assets Management and, of course, Economic Policy Analyst, thank you so much for sharing your perspectives with us on Business Morning.